Hello and welcome to this Wednesday's morning market briefing. We've got lots to talk about, but firstly, investors are scaling back their bets of a May rate cut over strong US inflation rate figures, as well as that most Nato members are now to hit spending targets as the alliance does brace for a potential Trump victory in the presidential election. We've got lots to talk about in the charts, also with lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you see that. Before we get straight into it though, make sure to subscribe. The first article to talk about is in relation to investors. Now, yesterday, investors pushed back the expected date of the first Fed interest rate cut. This comes following the US inflation rate figure was released, easing less than expected to 3.1%. Now, of course, we've been talking about inflation and, the Fed's interest rate a lot recently. And that is because most recently, well, not most recently, I guess, but within the last few months, the way the Fed has positioned itself around its monetary policy has changed dramatically. And that's affected markets greatly, if I can speak. Now, what's happened? Well, we were last year, in the middle of the year at least, going into maybe Q3 and then Q4, we were kind of looking at the Fed as more of a kind of hawkish institution at the time. It was more so looking at markets in a way which was wary of inflationary pressures in from a perspective which was more so in relation to either keeping rates higher for longer, which was a key term used by the Fed, or even increasing rates further. And that debate really arose over whether the interest rate would be raised once more in December of 2023. And this was all because the inflation rate for the US and other developed economies like the UK and the Eurozones ultimately was very, very high still, and remaining persistent despite the efforts by the Fed or the ECB or the Bank of England to deal with those high inflation rate figures. Ultimately, though, we did see a change. I can't remember whether it was October or November, but I believe it was around that time where we then did start to see the kind of Fed rhetoric and outlook changed from one which was very hawkish to one which was very dovish. And why was this? Well, consecutively, October, November, December, we started to see the inflation rate figures, which were usually very, very high. Ultimately, we started to see those dropping faster than previously expected, breaking what the economists were expecting, and therefore, kind of reducing what many investors perceived as, great inflationary pressures, and reducing that to, very weak inflationary pressures, and, therefore creating this kind of environment where investors were more so looking at when the Fed or the ECB or the Bank of England were to cut interest rates rather than when they were to raise them further. And that was the key change. Now, why is this inflation rate then so important that we got yesterday? Well, obviously, these inflation rate figures are the most important bit of economic data from the US or ECB or England, to see what is going on within those economies and what the Fed or the Bank of England or the ECB need to do in relation to their monetary policy. And ultimately, that is how we've been tracking what the Fed has done and how that Fed rhetoric has changed, as ultimately it was the drop in inflation rate figures which did cause the Fed to kind of move away from a position of looking to raise rates further to a position where we were more so talking about actually cutting rates. So that's why this is so important. Now, what figure have we seemingly received, and how might that affect the way the Fed conducts its monetary policy? Ultimately, it does seem like we got a higher than previously expected inflation rate figure. Now, why is this relevant? Well, in the last inflation rate figure we actually got, kind of that also surprised investors. So whilst we've spoken about how investors and the Fed kind of moved to a more dovish position following a series of lower than expected inflation rate figures, ultimately the last one before this one, we did in fact see inflation come in above expectations, and therefore that worried certain investors which were more positive and bullish on the side of US equities, as well as less kind of bullish and more bearish on something like the dollar, which of course depends greatly on the Fed's interest rate. But ultimately, once again, we're seeing this kind of surprise to many investors and economists in regards to the US inflation rate figure coming in above expectations. Now, by no means does this mean that the Fed is going to increase interest rates further. We've heard from numerous Fed officials that that won't be the case. But ultimately, this is super important because whilst we're looking at when rate cuts are going to start, it's important to see how those inflation rate figures are, coming out. And ultimately, what the Fed has said time and time again is we'll make interest rate cuts when we believe the data says it's right to do so. And if we are continuing to see these inflation rate figures, whilst they may be low, around 3%, if we continue to see those figures around 3.1%, 3%, 2.9%, we can't say that inflation has been eradicated to the extent that it needs to be before interest rates can start to be cut. As ultimately the Fed wants interest rates, as well as the ECB, as well as the Bank of England, want the inflation rate to be at that kind of 2% target before interest rates start being cut, just so that they're sure that there's no more significant inflationary pressures within the economy. So that's why this is so important indeed. Following the data release, the futures market priced in the chances of a rate cut in May at 30%, which is down from 50% before the data was released. This now has reduced the chances of a rate cut in March to nothing. In response to the data, the US 2-year yield rose 0.14% and the 10-year yield rose 0.11%. Now, the S&P 500 also fell, dropping by 1.1%, as well as the Nasdaq dropping 1.2%. The dollar, on the other hand, moved 0.6% higher. As we do know, the dollar is very much dependent on the US's interest rate. As ultimately, if we're seeing, higher than expected inflation rate figures coming out, we're more likely to expect the US, Fed to basically keep interest rates higher for longer, therefore providing those holding the dollar or holding a lot of cash in dollars within checking accounts or savings accounts, we're more likely to see money flowing into those accounts because they're able to hold on to that higher interest rate for longer than previously expected, which is why we're now seeing the dollar move up to the upside when previously and more recently we've been seeing the dollar move to the downside following that more dovish rhetoric from the Fed. Now, the importance of this data release weighs on the decision facing the Fed around rate cuts. In comparison to the 3.1% figure that was released, economists were expecting 2.9%. The core inflation rate figure, which is more closely followed by the Fed, saw no change, remaining at 3.9%. The new focus of central banks on the prospect of rate cuts is driven by recent inflation drops across the developed world, with the Fed Chair Jerome Powell, going from talking about rising rates at the end of 2023 to talking about cutting rates 3 times this year. And we know that investors are expecting even more cuts than that. It seems housing, vehicle insurance, and medical care all applied pressure to prices in January. So this is very important to kind of keep your eyes on. And of course, we're kind of coming back to it on the charts in a minute when we then talk about the dollar and the US equities. So stay around so you can see that, where we'll talk about this figure once again. Next article to talk about, though, isn't to do with Nato, which is very important indeed, as at the moment we're experiencing a great deal of world tensions. And as we are in the run-up towards, of course, the US presidential elections of 2024, it's very important, of course, to understand who the key candidates are, what's the key kind of policy positions, but more importantly, what are their policy positions and opinions around key foreign policy issues. We know there's been this great divide now emerging within the US around foreign policy, with many of the more Republican Trumpists within the USA, kind of being more anti-funding Ukraine, more so focus on domestic issues, stop sending aid to foreign nations, that kind of thing. Whereas the Democrats have more so been kind of seeing this from a more globalist view, where they're able to kind of understand how maybe the the allies within Europe are very important to the status of the US on the world stage, or even in their own, in the interests of the USA, in its own right. So this is why this is so important to understand and keep your eyes on. Now, NATO is set to announce that its members are mostly on track to meet their spending targets. This comes in expectation of the more isolationist Trump winning the US election. Now, not too long ago, maybe last week, we actually spoke about Trump's rhetoric in relation to letting Putin or Russia invade into NATO allies within Europe if they were to not meet the 2% spending target. And this is something that he had previously said to a European ally within NATO, he said on a rally, and he basically explained that this was his way of forcing and almost pushing many of these European NATO allies into a position where they're forced to actually meet their spending targets and actually put forward enough capital and enough financial investment into NATO to be a worthy member. And this has kind of been Trump's strategy traditionally of showing that the US is strong, that he is not scared of conflict, to even his own allies, to make sure that deals and kind of agreements are being enforced by both parties. But of course, this was kind of a worry to many, as it kind of inflamed a lot of the tensions within NATO itself, and in a time where Russia's invading into Ukraine, when NATO is supposed to be strong as an organization, as an alliance. This worried many, as it seemed that Trump was once again siding more so with Russia than many Democrat speakers or leaders such as Biden, which are very have come out with clear support for Ukraine, whereas Trump's kind of been more so on the fence, it does seem. So this is why this is so important to understand. With 18 of its 31 members meeting the 2%, will meet the 2% of GDP spending on defense target, with this number also being likely to rise as budgets continue to be adjusted. NATO spending first rose higher following Russia's invasion into Ukraine, but also before that when Trump's serious rhetoric around increasing allied defense spending caused many nations to increase their percentage of GDP being spent on defense. And this was during Trump's presidency and during the time where he did say that thing to European allies within NATO. Now, in comparison, in 2016, so before Trump was president, only 5 of the NATO allies met the 2% spending target. And now nations such as Poland even spend more than the US, with Poland spending 3.9% of their GDP on defense. Now, Trump has declared himself as a NATO skeptic and isolationist, and has previously threatened to withdraw from the alliance. European leaders were once again shocked by his rhetoric after he said that he had previously told European allies that he would encourage Russia to do the hell that they want with any European NATO ally that does not keep up with the spending target of 2%. So this is very important to understand and will be greatly affecting world tensions. So keep your eyes on it, but also, keep your eyes on it to understand more about the US presidential elections. That's all to talk about in the articles, though. Next to talk about, of course, is the charts, where we do have quite a bit happening, and we are starting off on the US 30, so US indices as a whole. And following that inflation rate figure that we spoke about at the start of the video, we have now seen US indices kind of crash to the downside. This is very much an expected move that we are likely to see always when we do see inflation rate figures kind of come in above expectations, and therefore cause certain cause investors to become hesitant and worried about equities markets, as often and always really, these equities do depend on interest rates, for their, borrowing and therefore their expansion. So they need that capital to expand, and without that, they then, are likely to see poorer financials and not as much growth, and therefore that's factored into many investors' perceptions. And as a result, we do see a sell-off following those higher than expected inflation rate figures, and that is what we have seen. Interestingly though, price does seem like it has come down and spiked that key liquidity zone and support area around the old 38.2% Fibonacci retracement zone. If we were to then extend that to modern day times, we would more so be looking at price coming down all the way to that 50% level. But still, it does seem like the body of this most recent bullish candle to end off the day did kind of, come down and close above that key liquidity zone, and price does seem like it has spiked into that level, exploited that liquidity, and now maybe on the move back again to the upside. So whilst we are seeing that kind of more bearish kind of movements following that inflation rate figure, ultimately it's interesting to see how price is still kind of setting itself up to continue a move to the upside. So definitely keep your eyes on the US 30. It is by no means, gone into full bearish territory following that inflation rate figure, as ultimately it is these kind of maybe smaller startup tech companies which depend greatly on these interest rates rather than these massive US conglomerates, which ultimately are able to just go to their cash reserves or their massive cash stocks when they do need cash. So they are not so much dependent, on these higher interest rates, unlike these smaller companies, which is why we're not seeing too much of a reaction following this inflation rate figure. But still keep your eyes on the US 30 nonetheless. Next to talk about, of course, though, is the dollar, which greatly depends upon the US inflation rate figure, and as we've previously noted, because it massively depends on the interest rate of the United States of America. Now, as a result of that higher than expected inflation rate figure, we have now seen price once again jump to the upside, and this is kind of to be expected, as investors, of course, as we explained earlier, are now pricing in those higher the interest rates staying higher for longer than previously expected. Now, price, interestingly though, is nearing that minus 27.2% Fibonacci extension level, as price did move before we've neared that level. Price did jump from this 38.20 Fibonacci retracement level, which lined up with that key area of liquidity, and price had been sitting on that for quite some time. But as I noted in previous market briefings, I did note how price was seemingly setting itself up for that Fed interest rate decision. Well, not Fed interest rate decision, the US inflation rate figure, by kind of setting itself up between these two key liquidity levels. And I did note how it seemed like investors had got in their sell side hedges around this level up here, and investors were then preparing buy side orders along this 38.20. As a result, preparing for whatever news does come out, and therefore enabling themselves to make profit either way. And so as a result of that inflation rate figure, as a result of that kind of reinforcing a more hawkish picture for the dollar, for the US monetary policy, and as a result a more positive picture and bullish picture for the dollar, we have seen the dollar jump to the upside. What will be interesting though is whether we can reach that Fibonacci extension level. Keep your eyes on that, and of course we do have the opportunity for price to now retrace and come into contact with this key liquidity zone where we've previously moved to before. Next to talk about though is Euro USD, which has continued to break lower as a result of dollar strength, of course. Not too much to say on that. Next to talk about though is pound yen, which is very important to talk about, not only because we're getting some very, very important pound and yen in data today, but also because pound has now broken those long-term highs. We could say all-time highs, but they're not all-time highs, but highs not seen for years, as price is now on the serious upswing. So it has now broken above that kind of short-term minus 27.2% Fibonacci extension level, and it's broken above those most recent highs and this key resistance level that we had noted, as price did kind of come into contact with that for the third time, and as expected did come down, retrace, come into contact with the 38.20 and key liquidity zone, before then moving on the upswing to the upside, and is now pushing nearer and nearer to that minus 27.2% extension level. So, Fibonacci extension level. So that's a very key area. But, quite interestingly, price did also come into contact with that 190 level, which of course is a very psychologically significant level, which explains why price has reacted to it already. So definitely keep your eyes on pound yen. Very, very interesting to know. To get through quickly though is Bitcoin. Bitcoin has reacted to that $50,000 Bitcoin level. Of course, that's to be expected. It's a key psychological level. So price has sold off from that level and is now kind of consolidating. Next to talk about is gold, and gold, of course, as a result of the dollar gaining strength. We have seen gold sell off enormously to the downside. Of course, we have to think in the long term, though, what are world tensions also at? We know that that's been pushing gold to the upside most recently. So, we have to factor that in, and also, ultimately, the US interest rate is still expected to be cut around May time, maybe later than that, but still around around that period. And so if we're kind of still expecting those inflation that interest rate to be cut a lot earlier than other pairs or currencies,